Hello and welcome to module number 11. Today we're going to be talking about forecasting financial statements. Module 11 marks a slight change from modules 1 through 10, where we were taking a deeper dive into the accounting and analysis of the business. In module 11, we're going to begin to use all of the accumulated knowledge that we've gathered over modules 1 through 10 and put that to use, creating a picture of what we, as the analyst, you as the analyst, believe to be the most accurate representation of a company's future cash flows. And to do that, we're going to have to forecast revenues and forecast expenses, and that'll produce a forecast of net income and flow through to the balance sheet. And as we do that in the for next year and the year after that and the year after that, we'll end up with a 3 to 5 to 10-year forecast that produces a series of cash flows, which we will use to create a discounted cash flow valuation of the business, or what you might think of as the company's true underlying intrinsic value. And the market has shown over time that when this skill set is applied well, you can identify dislocations in the market, meaning true economic values or true implicit values that differ from the current market price. And that creates opportunities to buy or sell a stock and create a portfolio and build a business out of managing portfolios on behalf of investors. So the first step is to know the business and the accounting for the business and all of the peculiarities that result from that, and be able to reconcile for those, as we have done throughout this semester. And then the second step is to take all of that accumulated knowledge and put that to work in creating a forecast, a believable forecast for your management teams. And as we've touched on in the past, one of the most crucial elements of this is being able to identify any inflection points or points of differentiation between what you've uncovered in the last 11 modules and what the general consensus viewpoint is on Wall Street. Because if you build a financial forecast that is a consensus financial forecast, meaning that it is substantially similar to what's being produced by Wall Street, then the discounted cash flow valuation that you place on that business will be substantially similar to the price where it trades, which is not to say that you've done anything wrong. It's just to say that you haven't identified an opportunity. And as you'll find, if you pursue a career in this industry, these opportunities are few and far between. So it may be an indication that you've done everything right and just haven't identified an opportunity that you can exploit with a purchase or a sale. So let's get into module number 11 here. We'll begin with our first learning objective, which is to explain the process of forecasting financial statements. And I gave a nice open to what we're after here, and the authors remind us that we're evaluating strategic opportunities and looking at that from the position of a shareholder. We've touched several times in the past on the perspective of bondholders and other stakeholders in the business, but for the purposes of this exercise, we're primarily going to be looking at this from the standpoint of a shareholder in the business. And that all starts with the revenue forecast. Top line sales, you can think of this as organic growth, or what we expect to be sales next year. And this is one of the simplest deviations or simplest points of differentiation that you might see vis-a-vis forecasts that are coming out of Wall Street. And that's entirely on account of the human condition, which is built. This is in our DNA. This is how we've evolved. We see 1, 2, 3, 4, or a string of data points that create a line, and our natural tendency is to take that line and extrapolate the 5th or 6th or 7th data point on that line. And that's what we have a tendency to see from the Wall Street community as well. which is why you've heard me say several times this semester that part of the art of being a good financial analyst is in being able to identify an inflection point for the company. And that's where all of the true skill set lies. That's where all of the true opportunity lies. If you've produced a trend line forecast for sales, it's also likely that you have not identified an opportunity. Again, that's not to say that your sales forecast is wrong, because some of these businesses are highly predictable and they create sustainable business models that grow at a predictable rate year after year after year. So if your business has been growing at 2% or 3% or 4% historically for the last decade or 2 decades, it becomes highly likely that next year you're going to be able to take last year's sales and multiply them times 1.03 or 1.04 and produce an accurate estimate of what you might expect for this year's sales. So you can see this nice little graphic at the bottom of page 4 here that shows the income statement and balance sheet accounts directly impacted by the revenues forecast. And any of you, all of you, as a matter of fact, have a familiarity with the accounting behind this that drives this. That sales forecast flows through to cost of goods sold and operating expenses. We'll talk a little bit about how we can forecast those next. And then the revenue forecast will similarly affect the balance sheet, as most of those items that you see there on the bottom of the page have a tendency over time to fluctuate with sales, which makes sense, right? Take accounts receivable as a primary example. As your sales grow, your percentage of sales sold on credit will similarly grow, and your accounts receivable account that shows up on the balance sheet should be a function of that. Recognizing that, we can look back at history, compute accounts receivable as a percentage of sales, and use that trend or that number to forecast accounts receivable in the future. And we'll take a deeper dive into how that unfolds too. Here's an important point on consistency and precision. Consistency refers to what I'll call the smell test. All of these financial statements work together. So the relationships between the major line items and accounts that has held in the past needs to hold in the future. So for example, in that last example I just used, where we looked at accounts receivable as a percentage of sales, if we forecast accounts receivable in the future, and then subsequently take a look at that ratio, and we see accounts receivable as a percentage of sales fluctuating from 10% to 12% to 14% to 18%, whereas historically it might have been a steady 6%. Well, that's something that probably doesn't surpass the sniff test. It's not internally consistent with the historical numbers that the business has generated, and therefore likely an indication that something's amiss. We can similarly do the same thing with all of the ratios that we've looked at in the past that we studied in Modules 4 and Modules 5 and Module 6. Look at gross profit margins, asset turnover, inventory turnover, so on and so forth. So as you have already done in preparing some of these ratios for your semester case project, be prepared to generate those same ratios into the future, and then analyze them historically across your time series to see that there are no major deviations or fluctuations, and or if there are, you're in a position to be able to explain those, and have explained those in the body of your research report, because I will be looking for that. I will be looking for that internal consistency, and when I see any deviations from that, I'm going to want to know the reason why. And that reason why also likely explains the opportunity that you see when you value this company and come up with a number that's a significant deviation from the underlying market price. Okay, level of precision. Estimating cost of goods sold, as the authors give us an example here, to the nth decimal point is meaningless if we have imprecise forecasts. And the example that I like to give is that the difference between finance and accounting is that with accounting you can be precise because you're dealing with historical numbers, and they should be precise. You should be able to follow the penny to see where every last fraction of your income statement and balance sheet and bank account foots and crossfoots, to use accounting terminology. But with finance, we're trying to forecast the future, and that's a crystal ball at best. So the best we can ever hope for is to be directionally correct, meaning, do we have some measure of opportunity here? And when we discount these cash flows back to time zero, what we'll be looking for is an opportunity that we can layer in a margin of safety of 20 or 30% and have a high degree of confidence that even though we've probably gotten something wrong with our forecasts, we still know that we're directionally correct and therefore can be confident in issuing a buy or sell decision. So just keep that in mind with your forecast. Be directionally correct, be as accurate as you can, but don't get so caught up in the details that you miss the forest through the trees, so to speak, by spending so much time on cost of goods sold or other measures that just aren't necessary. And as a matter of fact, that level of precision might become a detriment to what we're really trying to do. Okay, moving on to the next slide here, let's talk a little bit about forecasting with a sensitivity analysis. And this is a good segue from that last point on precision. As we build our forecast, we should do it in a way that is consistent with the review of ratios and other key performance indicators that give us insights into which levers are most impactful for forecasting the future cash flows of the business, and which levers are most impactful for creating a discounted cash flow valuation that will yield the implicit stock price of the company. So for example, when we forecast our future financials, typically what you'll see is that one of the most sensitive inputs to the forecast and thereby the discounted cash flow valuation becomes our revenue forecast. And that's generally driven by our revenue growth rate. So when we prioritize the inputs to the forecast that are more important, we need to know which one of those are more sensitive, are more impactful, drive more of a deviation in the outcomes. And by knowing that, we can prioritize our time and be a little bit more precise. So I belabored that point a little bit on the last slide between consistency and precision, and ended by making the point that we don't want to be too precise, else the whole exercise becomes detrimental. But at the same time, there's a counterpoint to be made, which is relevant here when we discuss sensitivity analysis. For some of those variables that really do have a greater impact, it's worthy of putting some time into and being able to explain even the smaller deviations. And certainly revenue forecast would be one of those. When we move into discounted cash flow valuation next week, you'll see that the discount rate is similarly one of those that's highly sensitive to the valuation that's ultimately yielded with that analysis. Learning objective number 2, forecasting revenues and the income statement. When we forecast revenues and the income statement, we're always going to start with net sales, and what you're looking at here on slide 8 is the income statement that our authors share with us from Procter & Gamble. This was from fiscal year 2017, and you can see here how in fiscal year 2016, top-line revenues were 65 billion for Procter & Gamble. And as a percent of net sales, which is the number in the column immediately to the right of fiscal year 2016 sales, you can see each of the line items on the income statement presented as a percentage of net sales. So let's just walk down the income statement here. We go from sales to cost of products sold or cost of goods sold, which amounted to 50.4% last year. Selling, general, and administrative expense was 29% of sales last year, Operating income was 20% of sales, interest expense, interest income, so on and so forth. And you can just walk down the income statement, presenting each line item as a percentage of sales. Now, in this example, we're only looking at fiscal year 2016 presented in this manner. When you do the work on your semester case project, what you'll want to do is present the last 5 or 6 or maybe even 10 years in this manner so that you can observe the trend. And when you do observe the trend, that's going to help you forecast your next fiscal year, which in this example is fiscal year 2017. And you can see here that the forecast that this analyst has come up with is a 1% growth rate. And then they have an explanation off to the side here, which I would expect of each of you in your case project to be able to explain how you come up with that number. So our authors here note that they are using Procter & Gamble's company guidance that sales will increase about 1%, which equates to 2% organic sales increase, less 1% foreign currency effect. So the sales forecast thereby equals the current sales times 1 plus the growth rate, and that growth rate came from management. And in their analysis, this analyst didn't find any compelling reason to differ from management in that forecast, so it was taken at face value. Okay, fair enough. Now moving down to the second line item there, cost of products sold, the analyst forecasts a drop in cost of products sold from last year's 50% of sales to this year's 48% of sales, plus a little bit. And the explanation that they give is to assume cost of goods sold as a percentage of sales will continue to decrease due to Procter & Gamble's productivity initiative. Now, where did they gain insights into Procter & Gamble's productivity initiative? Well, this was probably explained and elaborated on by management in some of their quarterly earnings calls. This could have been an analyst presentation that Procter & Gamble's investor relations team gave. This could have been in some analyst commentary that could have been disclosed from the Thomson Reuters database, or any one of the numerous different sources that we reviewed early on in the semester, and you should have accumulated by this point in the class. So because of all of the wisdom and knowledge that you've been able to gather to this point, an initiative like Procter & Gamble's productivity project should be a known thing and should come in very handy when forecasting these financial statements. So moving on down, I'll let you take each of those explanations one by one, but you'll see a consistency there. We're benchmarking the forecast to the percentage of net sales number from last year, and one by one explaining any deviations from last year or from trend based on what we know to be true about the company and what we've learned to this point. So when we look at those individual line items, we can go into a little bit more detail here. And we see that our authors give us some rules of thumb, so to speak, for sales, and they note that insofar as sales is concerned, the most common manner in which we forecast sales is as a percent of sales. You'll see that until you get down to tax expense and some of the more transitory items that just don't function as well. That metric, those line items presented as a percentage of sales, is not as successful in creating a forecast. So for tax expense, that'll be a function of taxable income as presented on the income statement, which will naturally flow from the forecasted line items and revenues and expenses. And then we should have some insights from reviewing all of the disclosed taxable information in the 10K, which was in a prior module. As you incorporate that into your analysis, you may come to determine that the tax rate next year is going to be greater than or less than last year, given various things that come to light, and incorporate that into your forecast for tax expense. Our authors give us some insights into cost of goods sold, that is, it was presented on the previous slide, and they note that in deviating from prior year's 50% of sales to current year's 48% of sales, they included information that was specifically disclosed by management team and where they thought they could gain those specific efficiencies from their productivity initiative. So this is an absolutely wonderful example of what I expect you to be drawing out in your semester research report. On this slide, our authors give us some additional detail on how additional accounts were forecasted. For SG&A expense, they stuck to a traditional percentage of sales methodology. For the income tax expense, you can see here that a effective tax rate of 25% was used based on the information that was disclosed in the 10K, as can be seen on the bottom of slide 10 here in the chart. Looking at fiscal year 14, 15, and 16, you can see that the effective tax rate went from 21 to 24 to 25, and in forecasting 2017, our analyst here didn't see any reason to deviate from last year's effective income tax, and that's a just fine way of forecasting that particular line item. Okay, let's move on to forecasting the balance sheet, which would be learning objective number 3 here. And we can see Procter & Gamble's balance sheet for fiscal year 2017. And again, we're going to take 16 and we're going to present that as a percentage of sales. So no different than what we just went through for the income statement. And you can see cash and cash equivalents and available for sale securities and accounts receivable and so on and so forth, each presented in this manner. And again, like I noted with the income statement, it's really your job as the analyst to not only present these numbers for the last fiscal year, which is 2016 in this example, but also 15, 14, 13, 12, go 5 years back, go 10 years back, so you can observe the trend. And also have the heads up, have the presence of mind as an analyst to know that those numbers are really only going to be useful if your company, historically speaking, is substantially similar in form as it is today. That's to say that if your company went through a huge merger last year, it's no longer substantially similar in form, and therefore looking back 3 years, 4 years, 5 years ago will be of much lesser significance than it otherwise would be if you had a more consistent operating history. Okay, so now that we have our numbers presented as percentage of sales, let's look at the computations column for each of these and the estimate that's generated in 17, the percentage of sales, and explanation to go along with that. So for cash and cash equivalents, as you'll see, that's our plug figure. We're going to forecast every other line item on the balance sheet, and then we're going to come back to cash and cash equivalents and forecast that last. And that'll be a simple exercise of calculating the number that needs to be to allow the balance sheet to balance, and that becomes a plug figure. So once we forecast everything else, we force the balance sheet to balance with the cash and cash equivalents line item. And that's not a simpleton's forecasting technique. That's simply what's left over after we run our business for the year. And that's exactly what the cash will be if we nail our forecasting assignments for every other line item. So let's look at available for sale investment securities. You can see that last year that was 9.6% of sales. And in our computation column, you see no change. So the estimate for 2017 becomes the exact same number. It doesn't change at all. And that makes perfect sense too, right? Because the available for sale investment securities, that's not going to change if sales could double, sales could triple, and that line item would be exactly what it was last year unless we sold some of those. So we're not going to make the assumption in this analysis that any of those are actually sold. We're just going to leave those on our balance sheet, and the value will be representative of what it is this year. Moving on, however, accounts receivable, now that actually is a line item that should function with sales, and the same comment applies to the next 3 line items: inventories, deferred income tax, prepaid expenses. Those all are intuitive that they would grow as the level of sales grew. So you can see in the computations there, we're taking our sales forecast from the prior slides of $65,952,000,000, and we're multiplying it by, in the case of accounts receivable, 6.7%. So the implicit assumption there is that accounts receivable as a percentage of sales stays the same. And if we had a trendline forecast and we're able to show that that had been 6.7% for the last 2 years, 3 years, 4 years, 5 years, then we could make an extremely strong case that that was an accurate basis upon which to form our forecast for accounts receivable. And the analyst in this case has kept that same general framework in place for Procter & Gamble here all the way down to current assets held for sale. Then you can see the explanation there is to forecast working capital accounts as a percentage of sales using the prior year percentage unless information were to suggest otherwise. Okay, so now we're down to total current assets, property, plant, and equipment. We do the same thing with property, plant, and equipment. And the explanation that our authors give us here is that CapEx estimates are from P&G guidance, and depreciation expense is computed as a percentage of prior year PP&E. Assume no changes because goodwill is not amortized. Apply estimated amortization expense from footnotes of P&G. Assume no change. Okay, so that's a lot. Let's unpack that a little bit. CapEx estimates are quite typical from company guidance. It's likely that you're going to be able to find those somewhere. This is common guidance from companies because it gives analysts insights into the new facilities that they're building. Permits need to be filed. Zoning privileges need to be gotten from the city. These are known projects, and companies will generally give some detail about the level of CapEx that they expect for the next few years. So when that's a known, we don't have to use the percentage of sales method because we have something much more accurate if we believe management. And that's not an inconsequential question. Management's credibility is a huge part of everything we do as an analyst. So if we believe management the determination of that is a big deal. But for the sake of argument here, we have assumed that their guidance is going to be somewhere in the range of 3.4 billion to 2.6 billion. And we've created a 2017 estimate of 20 billion, which amounts to 30% of sales, or a little bit over what it would have been last year. And of course, that's net property, plant, and equipment, so we have to factor in depreciation and amortization along with that. And our explanation gives us some guidance of what we expect both of those to be. So you, as the analyst for your semester case project, will have to go through a similar type of analysis to determine what your property, plant, and equipment is. Goodwill generally doesn't change, and as you can see here, it's remained the same in this analyses as well. Trademarks and other intangibles, other non-current assets, you're really going to have to dig into the footnotes to see if management expects any change to these non-liquid items. Okay, let's continue on with the bottom half of the balance sheet. In this slide, we're looking at the liability section and the equity section of the balance sheet, and you can see here that we begin with working capital items, and similarly to the top half of the balance sheet, we're going to forecast each of those with the same metric. Each item presented as a percentage of sales, and then moving down to debt due within 1 year, for example, you're really going to have to take a look at the explanation, and in this case, we're using the footnotes to get maturities of long-term debt to be repaid in the current year. So we looked at the footnotes associated with long-term debt in another module. We've looked at the footnotes associated with taxes and pensions and leases and you name it. Pretty consistently with every module, we've been looking to the footnotes, and that gives us additional details that we need to incorporate anytime we're trying to create an accurate forecast for any of these line items on the income statement or on the balance sheet. And the balance sheet in particular can be a little bit more challenging to forecast in light of some of that information, or it can be simpler to forecast if management has given clear guidance on what they expect that to be. So long-term debt, let's look at the explanation for that. We're using the footnotes to get current maturities there. Deferred income taxes, non-current liabilities, we're using percentage of sales. You can see there that with many of the equity line items we have no change forecast whatsoever, or we're assuming guidance. In the case of Treasury stock, retained earnings will simply be increased or decreased by our net income and dividends on the year. Dividends are usually a fairly consistent policy, and likely we have guidance to forecast what those are, and then the total liabilities and shareholders equity section will post, and then the last step for forecasting our balance sheet would be to circle back around and again compute the cash value necessary to make the balance sheet balance. Slide number 14 is a nice little review of what we just went over, some rules of thumb for forecasting each of the major categories on the balance sheet. I'll let you take that on your own time. Same way with the plug figure. I mentioned that we always need to circle back around as the last step in the process, so don't forget that one. Working capital accounts, we spent a little time on those, almost always forecasted as a percentage of sales. And again, that makes sense because you would expect your working capital to grow fairly consistently with sales. The one caveat there is that we may deviate if we have a specific guidance from management on one of those accounts, but that's the exception rather than the rule. Okay, as you'll remember, forecasting the property, plant, and equipment was one of the more complicated forecasts that we reviewed for either the income statement or the balance sheet. So our authors give us this nice little cheat sheet here that shows up on slide number 17, and we can take them one by one. Capital expenditures may be company guidance or maybe percentage of sales, and if they're percentage of sales, then that equation would follow from forecasted CapEx would equal the current year CapEx over sales times forecasted sales. We did that several times in the forecasting of the balance sheet. And then depreciation. If depreciation has been consistent, then we can take the current year depreciation expense and divide by property, plant, and equipment, and take that number and multiply by the current year property, plant, and equipment to get depreciation. We're really just holding depreciation as a percentage of PP&E constant. And that's a fairly shorthand way to estimate depreciation, and it goes back to the concept of precision. We don't have to get that one right to the fourth decimal point because that's never going to be an input that creates a lot of sensitivity, meaning our analysis is not going to be highly sensitive to our estimate of depreciation. That would be a rarity. And then lastly, we have, after we have our forecast of capital expenditures and depreciation, we can forecast our net PP&E by adding the current PP&E plus CapEx minus depreciation to get net PP&E. Intangible assets are another category whereby that precision element comes in, and I've mentioned this concept with other language in the past, or prior to this semester, where I will advise everyone to be aware of the materiality. And in this instance, we have intangibles that are a rather small part of Procter & Gamble's total balance sheet. So take a stab at forecasting these, and if we have guidance, that might become very easy. And if we don't have guidance, then we might just simply impute an amortization expense that's on par with whatever the amortization expense was last year, as our authors give us an example of here on slide 18. But again, if these numbers are insignificant or immaterial, then we don't have to spend much time racking our brain over how precise to be with these. Any forecast is gonna work, get us in the ballpark, and allow us to move on towards other things that are much more crucial in forecasting, what our company is truly worth. Okay, I can move pretty quickly through these next couple of slides because they're disclosed in the footnotes and we've reviewed them in prior modules, and long-term debt is one of those. Current maturities of long-term debt will always be disclosed in one of the footnotes, and when we know that, it creates I guess an ease of use or or a simplification to forecasting that long-term debt line item. Although we do need to be cognizant of management's plan for taking on new debt, and they may have made mention of that in one of the analyst calls or one of the earnings calls, or paying off debt in an unforeseen manner. And sometimes fluctuations in interest rates can create opportunities for management teams to take advantage of that. And we looked at dislocations between par value and market value in a prior module as well. So if you see a major dislocation, then it might be wise to ask management if they have any plans to take advantage of something like that. But in absence of an otherwise compelling reason, that long-term debt projection becomes a rather simple calculation. Retained earnings is a similar story. We're going to take retained earnings from last year, add net income, subtract dividends. We typically know what dividends are. Companies try to keep their payout ratio constant. So monitor that, and if there's an expectation that dividends are going to increase, you will probably know about it because management teams oftentimes forecast those. If dividends are going to decrease, which would be a cut in dividend, that's almost always a surprise from the standpoint of the analyst community, because companies don't like to forecast that because it's typically not well received by the investor community. When a company cuts its dividend, you'll usually see the stock price decline significantly. So that's an opportunity to differentiate yourself as an analyst. If you see a company's cash flows begin to wane, if you see the liquidity begin to tighten up, if you question their solvency for any reason, and you see a historically high payout ratio, well, that might be a source of cash for a company that needs cash. And they may choose to cut that dividend so that they can have a greater level of liquidity to operate the day-to-day of their business. And if you see the handwriting on the wall, so to speak, then you can forecast a dividend cut. Well, that is a tremendous opportunity to do a huge service for your clients, shareholders, your boss, whoever it is that you happen to be reported to. And maybe if you want to go short the stock and bet against it, profit from its future decline when they do cut that dividend. So there's all sorts of opportunity here to differentiate yourself as an analyst. Forecasting treasury stock. You'll recall that treasury stock is the result of management engaging in the buying of their own stock, and sits on the balance sheet as a contra equity, I suppose, because we net that against stock outstanding. And any plans to purchase more stock are typically disclosed. Periodically, you'll see companies engage in the purchase of treasury stock on an opportunistic basis when prices allow and create value opportunities. That's almost an impossible thing to forecast because it's based on the current price, and we don't know what the current price is gonna be. We know what it should be because we're analysts and we can forecast that. But forecasting what it is gonna be is an exercise in determining what the rest of the market is gonna do with their money, and that's an impossibility. It reminds me of the famous Warren Buffett quote where he says, "In the short term, the market is a voting machine. In the long term, the market is a weighing machine." So to second guess how the rest of the market is going to vote is a very challenging thing. But to determine the long-term, true, underlying economic and intrinsic value of a company is a much more reasonable proposition. So we can do exactly that with forecasted guidance. If a company has a stock repurchase program, we can get some level of accuracy with regard to what we expect treasury stock to be next year. And if that's been disclosed, then we need to do so and make those adjustments on our forecast. Okay, moving on to learning objective number 4 here. Adjust the forecasted cash balance. Okay, so we talked about the cash balance being a plug, computed as total assets less all other liabilities and equities. We then need to forecast that cash balance and determine if it deviates from its historical norm, and that's what I refer to again as the smell test. If we've gone through all this work to forecast all the other account balances, and then cash becomes a plug figure that allows the balance sheet to balance, well, it ought to be in line with where cash has been historically. And if it's not, we really need to take a second look at our forecasts and understand where they're coming from. Because chances are we may have gotten one of them significantly wrong, which has led to what I will call a deviation in cash from its historical forecast. So to do this, we're going to use the current year cash to sales percentage, same thing that we've been using for all of our other line items to create that smell test or measure of reasonableness. And that has the implicit assumption of assuming that cash will fluctuate with sales, which is not a bad assumption. Over time, you're going to need more cash as your company grows, because you just run into more unforeseen circumstances, and cash is another element of working capital, and working capital grows as the level of sales grow. So that's cash as a plug figure. When it does deviate from norm, here's some more rules of wisdom or guidance. When it's much higher than normal, our authors note that this indicates the company's generating a lot of cash, most typically from operations, and that's fine. That would indicate that there's not a problem, like we haven't made an error. If we haven't made an error, then yes, 100%, our company may be doing some great things and generating a lot of cash. That's our best case scenario. When the balance is lower than normal, it might generate we're falling on hard times. It might similarly indicate another error, or it might indicate a large negative deviation in terms of borrowing, selling stock, liquidating marketable securities, anything like that. So just be prepared to know how to calculate the cash as a plug figure. Be prepared to know how to benchmark that to historical norms, and be prepared to explain any deviations from historical norms. And if you can't do that, then second check all of your forecasts to make sure that you haven't made a significant error. Okay, moving on to learning objective number 5 here. Prepare multi-year forecasts of financial statements. And we've already done all the heavy lifting. Once we go through all the numbers and prepare that first year, that next year, well, then the second year, the third year, the fourth year out, they just become the next iteration and the next iteration of what we've already done. So for Procter & Gamble, we looked at growing sales times 1%. Well, if we grow sales times 1%, then the subsequent year is going to be by 1%, and the year after that is going to be by 1%, unless we have reason to believe that sales are going to accelerate at a greater rate. And, again, given all of the information we've been able to accumulate throughout the semester in looking at modules 1 through 10, that's going to be something that we should know, we should have access to. Generally speaking, all of the other line items that we went through, one by one, we had good reasons for their forecasts, and those reasons are going to be consistent by and large as we forecast for 2018, 2019, 2020. Now, periodically we'll have reason to do something different, but when we have reason, there's going to be some justification for it, some explanation for it, be that management guidance or productivity initiative or sales initiative or some other company strategic plan that doesn't take place until 2 or 3 years into the future. And if that's the case, then 2 or 3 years into the future, we'll just need to adjust our numbers and make note of the rationale that we're using to adjust those numbers as we deviate from a percentage of sales method, for example. And you'll see that those numbers have a natural tendency to unfold as the out years become a function of that first forecast. So here you can see Procter & Gamble's balance sheet, and I'm scanning the computations line item. You can just look like cash. If you look at columns 1, 2, 3, 4, 5, 6, 4, and 7, you can see that they are nearly identical all the way down, meaning that our analysts here have chosen identical sales techniques for 2018, or identical forecasting techniques for 2018, as they did for 2017. And that makes our if you're in an Excel spreadsheet here, what that really means is you can hover your cursor over that column and just drag it across. And that's what I would encourage you to do as a baseline estimate, and then you can go back account by account and make any necessary adjustments that you need to make for further accuracy. In learning objective number 6, let's talk about refining forecasts with additional information. And the first piece of additional information that you need to make sure that you incorporate is company guidance. And look for company guidance from the Investor Relations website. We already touched on one piece that was used to forecast Procter & Gamble's income statement, which was organic sales growth here. You can see this was taken directly from a slide that Procter & Gamble shared at the Consumer Analyst Group, which was a conference in New York on February 18th, 2016. And at that conference, they shared that they expected their organic sales growth to be around 2%. They also shared that they expected an approximate 1% drag from currency and minor brand divestitures, resulting in an all-in sales growth of around 1%. Now, as you can see from slide number 27, that second line there, currency and minor brand divestitures. Management has visibility into the fact that they expect those two things to lead to an approximate 1% drag on sales in fiscal year 2017. But I'm going to ask you a question here. Is it reasonable to expect that drag to recur in 18, 19, or 20? Well, if you go back to slide 27 here, you'll see that no, analysts don't think, I guess it was actually slide 26. No, analysts don't think that that's reasonable to recur, and that's why, to get their sales forecast in 2018, they multiplied 17 times 1.02% instead of 1.01. That was the adjustment that they made to incorporate management's guidance for what would be 18, whereby this drag, it'll go away, or it's not something that would typically recur. So that's the type of thing that you need to be incorporating into your forecast. And there again, I know the project can be a little bit overwhelming because there's a lot that goes into these forecasts, and there's a lot of guidance, and there's a lot of other factors and industry trends and inflection points that we need to be on the lookout for, which is why this is a skill set that pays so well on Wall Street. If you can keep track of all this in a cohesive manner and make sense of it, there are analysts that get paid very, very well to do this. Here's some more company guidance from Procter & Gamble here on slide 30 that we need to be aware of. Guidance around adjusted free cash flow productivity, capital spending, dividends, share repurchases, and so on and so forth. Again, all those will factor into our financial guidance, so we need to be aware of that. Okay, let's move into segment data. For some of you, this will be very relevant if you're analyzing a conglomerate with different segments. It can also be very confusing because if you're analyzing a conglomerate with different segments, then you can go through this whole exercise that we've just spent the last hour going through, and you can apply that to every segment. That's a little bit more detailed than what I expect for your case study this semester, but it is exactly what you would see if you were applying this skill set in the real world for a company like Morgan Stanley, for example. And we can see some of that segment data and their forecasts on slide 32 here, where we take each of Procter & Gamble's segments, beauty, grooming, healthcare, so on and so forth, and we look at their net sales, earnings from continuing operations, net earnings, depreciation, total assets, and capital expenditures. Each of those can be forecasted, and for a company like Procter & Gamble, that can give you some insights into where exactly their growth is coming from, where exactly their margins and cash flows are coming from. And then for each of these, because they're different industries or different subsets of the same industry, you can go through Porter's five forces and a competitive analysis and an industry landscape and a SWOT analysis and so on and so forth, so that you can really truly understand the underlying drivers and opportunities associated in and embedded in each of these businesses. And again, for a company like P&G, that's beyond the scope of what I would expect for this semester's case study. But it is again entirely within the scope of what would be expected of you as an analyst. So if we're going to use that segment data, here's a nice chart at the bottom of slide 33 here that shows how we might begin to break it down. So for the beauty care segment, you can see here that this analyst has broken down organic sales growth into, they've taken total sales growth and broken it down into its constituent components that drive increases in sales, which is 1, organic sales growth, 2, volume, organic volume, so how many units we're pushing through, 3, the pricing of each of those units, 4, the mix of those units, because if we sell 20 units, different mixes can drive different levels of sales growth. 5, the currency impact, and then 6, any acquisitions or divestments that we might make in a given year. And this analyst has created quarterly sales forecasts for each of those, and then those would foot to annual sales forecasts. And again, if this is your first time to really go into this level of detail in creating an analysis of your company, then I have a hard time imagining that this isn't all quite overwhelming at this point. But when you break it down from the skill set that professional analysts are asked to apply, these models are built over time. This is likely a model that an analyst has been working on for a period of years, and with each call, with each analyst call, or company call rather, the analyst will go back to his workstation or her workstation and update this model. And that might take a couple of days to accurately upgrade this. And then as each quarter progresses, you have a nice little database that gives you real insights, and it becomes a manageable process. So here's Morgan Stanley estimates. They've done the same thing. They've broken down sales growth into organic sales growth, volume, pricing, mix, so on and so forth. And you can see here that they're factoring in certain divestitures and foreign currency impacts, and they have explanations for each of these. And just wanting to make you aware of what you see out there in the industry in practice. And then, of course, those would sum total up to a total forecast of industry growth. On slide 36 here, we can see the impact of acquisitions. And remember from a prior module that the impact of acquisitions will always be presented in required pro forma disclosures, which are in the financials, in the 10K filing. You're going to be able to see how net sales and really the entire income statement has fluctuated. And then think of pro forma as if, so these numbers would be presented as if that merger had occurred 3 years ago. So we will be able to observe a mini trend, if you will, of the last 3 years, and then it becomes our job to create ratios and forecasts from those pro forma disclosures. I talked earlier in this lecture about the meaningfulness of numbers that go back 3 to 5 years, and those being requisite on the company looking substantially similar to its current form. Well, if that doesn't apply, if there has been an acquisition, one silver lining to that is that there will likely be pro forma disclosures in the 10K filing. Same way with the impact of divestitures. Oftentimes those include pro formas, so we can look to those to help us out with the financial forecast in the same. And then lastly, our authors give us a final slide here, number 39, called Reassessing Financial Statement Forecasts, which is a opportunity for us as analysts to go back through and take a 50,000-foot view of everything that we've just created. And maybe we want to tinker around with that a little bit. Our authors here suggest that we do some what-if forecasts. So hypothetically, if our company were to fall on hard times or were to experience some strategic misstep, or have a failed product launch, what's that look like? What if revenues decline by 5% instead of increasing by the 2% we have in our forecast? How bad is that? And in practice, what you typically see are analysts that put together an optimistic scenario, a baseline forecast, and a pessimistic scenario so that they can, stress test how solid their company really is. What are the shock absorbers that are built into your business model? And then they suggest looking at all the key financial ratios, like I mentioned earlier, to do a sensitivity analysis and to basically just test the reasonableness of everything you've done as being representative of the totality of information that you've been able to gather throughout the semester. So that is Module 11. There's an appendix that will walk you through the forecasting of the statement of cash flows. That's a little bit beyond the scope of what we typically cover in this class. So I'll leave that to you to cover on your own. I look forward to connecting with you next class period, and thanks for your time.